reactions to the earnings releases so far have produced a return between -3 and +3%. As things have unfolded here thus far, this seems to be an environment where, having come into the last week with a rise in volatility already, the market seems like it's a little rich in that regard. So unless there's something significantly outlier in one of these reports, selling the vol and expecting the market to more or less stay pinned has been the best trading strategy, the best approach thus far on average, right? Over 50% of the time, that'd be the best thing to do. So I'm curious as to how you guys want to approach this moving forward, because we do have some big ones on deck here that are arguably more important than anything on the macro side this week, including that PCE report on Friday, because we know the inputs already. But with Apple, with Tesla, or rather should I say with Alphabet and with Tesla here coming up, these are two of the stalwarts that help power the Nasdaq rebound in recent weeks. We had the fabulous 5 and the terrible 2 reunited into the magnificent 7 with Apple and Tesla here in June and early July. So how are you guys playing these two big names today? Are you going to bet on this being a market that is like the average where we don't see a big move, or because of the names involved here, should we be expecting something beyond the ±3%?
There's a lot to unpack here, because the reality is that we actually did a couple pieces on earnings yesterday, some really good pieces with some historical perspective and some real-time kind of, we got into the nuts and bolts of a lot of these earnings plays. So far, I can tell you that on a trading basis, they have been very average. Today, obviously, the difficult thing about looking at the numbers that you looked at, Chris, is that you're not separating those by liquidity. And so when we look at earnings plays, you really have to be what we call the absolute minimum is 3 stars. And then 3.5 is like, we want 3.5 and 4-star liquidity to trade earnings. And so far, a lot of those numbers that you talked about, a lot of those numbers come from stocks that are smaller that aren't really necessarily that tradable.
For sure.
Just last night, as an example, the two biggest plays, the two biggest tradable stocks, Spotify and UPS, both were significantly outside the expected move. All the short volatility plays got crushed. It's not that at all that easy. The one that we played that was inside the volatility expectation was FCX, and it came in tiny. It didn't offset any of the losses in the other two. I think that it's important for people to realize that when you kind of the total of all the earnings plays, the numbers can be a little misleading, because you have to really focus on the ones that have, liquidity and relatively large expected move. Otherwise, there's no premium to sell. So tonight will be a very good indication. Two of the biggest stocks. The biggest stock so far to report was Netflix, and that was clearly inside the expected move, and that was obviously our biggest winner so far. Tonight come the second two biggest. I mean, of the top 10 stocks, you've had one. Tonight you have 2 more. We looked at these yesterday, and we kind of really got into a lot of the small details. And to us, it looks like Tesla is a more interesting play than Google. 1, because it's a little more liquid. 2, because it has a greater expected move. And 3, because for the last 4 years, it has had a better ratio of expected move of realized to actual than Google has. Google's been just tougher to make money on earnings. It doesn't mean anything looking into the future, but that's just where we stand right now. I think Tesla's just a more liquid underlying than Google. So far, I mean, I would say for us, the results are very mixed on earnings. We've made money on like 2 or 3. We've lost money on 2 or 3, and they're pretty much a wash. I mean, that's where I am on earnings so far. But I'm being very conservative because I don't like it when the starting point for volatility is so low.
Well, I think that's a very fair point. Quite frankly, I'm looking at this on the index level, but it seems that if there's going to be moves outside of the smaller band, perhaps, then it's going to be in some of those more meme stocky, top trending on stock twits or Wall Street bets kind of names that perhaps could produce that. Yeah, Either way, though, this also exemplifies the fact that it's a coin flip, right? A 51.3% accumulation of stocks trading between -3% and +3%. That to me is, I don't know if there's much of an edge there for traders. I personally really don't like trading earnings reports themselves because of the idiosyncratic nature and how quickly things can spiral out of control. It just doesn't fit with my macro upbringing, as it were. But when I look at something where there's only a 51% chance of something happening, like if I go to the blackjack table, that may be okay. But in the market, I want more of an edge than that. So I don't know if there's anything I see on the board that suggests there is something to be gained, because an average move of 0.4% that's not really anything to write home about in a low volatility environment. You really want to be selling a strangle there when you're at such a low starting point. So Tom, we didn't talk about this beforehand, but we kind of both looped around to the same point, which is this has actually been a very tough earnings season. And there's not really much advantage here right now because it's not producing anything reliable. It's a coin flip.
Yeah, no question about it. And yeah, I mean, I don't think that last earnings was a good earnings cycle either. I mean, anytime you have a really low starting point, implied volatility, earnings cycles are super hard because you are just by definition selling, like we talked about it, it is very difficult to make money. We looked at the ratio of expected move to actual price. And right now, you're a lot of stocks are in that. Well, I mean, tonight's going to be a little bit different because I think Google was 6x and Tesla was 8 times. But I think you're looking at a situation where just generally across the board, when vol's low, it just makes things a lot harder because the expected move is, a
lot tighter.
It's a lot tighter, and the news doesn't really change. You know what I mean? Like it's like you can still have bad earnings, you can still have good earnings. Like Spotify being a perfect example. What was the stock? What am I thinking? Oh, FedEx. Like when FedEx came out with earnings, stock was up $40 when it was up $40 when UPS came out, which was 2 times the expected move. When UPS came out, it was almost 2 times the expected move the other way to the downside. So there's not even a lot of sector comps or anything like that. It's really just a toss up. But the hardest thing about earnings, Chris, is that they are binary. So there's no real adjustment you can make until post trade. And then there's no vol left. So then you're just kind of playing like there's so little edge. The great thing about earnings are they are a very good engagement tool. The bad thing is there's really no edge. It's not even a macro edge or no edge in any sense. There's no vol edge, but people like it because it's instant gratification if you're right. And if you're directional, it's really instant gratification.
Oh, yeah. No, I've punched a few tickets over the years. 2014, Gilead, when they put out their hepatitis C drug, I was long a bunch of out of the money calls and, pay for the engagement ring, the wedding, what have you. But that's like the only success. No, Tom, I mean, literally at the engagement party, we cheers to hepatitis C being cured because like this is how this is all paid for. So, like that's the only good thing I can say about my earnings trading. I really have never had a consistent edge there.
Good
track record.
You cannot have
and it's difficult to do so.
You can't be consistent because even if you look at wins and losses, they come out random at around 50-50. So there's not like you can't say, oh, you've always got to be long, even though 80%, whatever you said, 81% of the companies beat earnings. It doesn't mean 81% of the stocks are up. In the end, they're going to be about 50-50.
Exactly.
So it's still, listen, we still do it. We do it smaller than we used to, and we do it a little less aggressive. Like I said, I think Tesla is the more interesting play tonight, but with an expected move, what we say, $22, $23, up a little bit today, $23, even $23 in Tesla. I mean, why can't that stock move $40?
Well, because the expected move is 23.
I know. Well, I'm looking at the August move in there, and I think that August move
$32.
was, what, 32? Yeah, I looked yesterday. I thought it was 33. So I went 2 times the expected move in August, $66 away. You can do it 25 or 50 cents better today.